So if you're watching this video, you're either new to investing or maybe you've been investing for a while but you're just not entirely sure what you're doing. And that probably terrifies you because the last thing you want to do is make some stupid mistake and lose all your money. And you have every right to be terrified because there are several key concepts that everyone needs to learn before they ever invest even a single dollar. Because if you don't fully understand these concepts, you are bound to make a costly mistake at some point or another. But don't you worry, because if you watch the end of this video, I'm going to walk you through every single one of these concepts. And the first question that we need to answer is, why do we even invest? Now, the primary aim of investing is to either preserve or build your wealth. And you might ask, preserve? Can't I just keep cash? Isn't that preserving my wealth? Well, that's the thing. It's actually not, because the cash that you keep is constantly losing value to a concept known as inflation. Now, particularly over the past couple of years, the inflation has been very high, and you may have noticed that everything all of a sudden costs a lot more than it did just a couple of years ago. And that's exactly the issue with holding a lot of cash. Now, cash is good to have in some instances because it's liquid and you can move it around and do whatever you need to with it. But you don't want to keep everything you own in cash, because cash doesn't grow over time. And in fact, if anything, it loses its value. If you're not familiar with what inflation is, basically the more money the government prints, the less valuable every dollar out there becomes. And that's basically why the price of everything increases over time. It's because the dollar is losing its value over time. Now, inflation is on average somewhere around 2 to 3%. We can just assume 3% to be safe, but that's the average rate, which means that there are some years that are lower than that, and then some years that are much higher than that, kind of like the last couple of years. But assuming that inflation is on average about 3% per year, we need to find a way to make at least 3% or more every single year. And of course, the way we do that is through investments. Now, there are two types of interest: simple and compound. A simple interest refers to when you receive the interest on your principal and not the entire money. So for example, if you have $1,000 and you get 5% simple interest on that every year, that means that after the first year, you get 5% of 1,000, which is 50. So in year 2, you're gonna have 1,050 total. And then the next year, again, you're gonna get 5% on the initial $1,000, which was your principal. So you're gonna get another 50 and you're gonna be at 1,100, and so on and so forth for every subsequent year. Basically, every year you get $50 more. But with compound interest, the way it works is that you get the interest on the total amount. So that includes all the previous interests that you've received. So for example, if you have the same exact situation, but this time with compound interest, the way it works is that the first year, it's the same. You get still $50 because it's 5% of the 1,000. But then going from year 2 to year 3, you get 5% on the 1,050 instead of the 1,000. So this time you get $52.50. Now, of course, in the first couple of years, the difference is very small and almost negligible, but the power of compound growth is over a long period of time. In fact, if you look at this chart, it can show you how crazy and out of hand compound growth can get. All you need is just 20 plus years of time for compound growth to do its thing, and then all of a sudden you have so much more from that investment compared to the simple interest investment. Also, the amount of interest that you get is directly correlated to the amount of risk that you're taking with your investment. For example, if you're going for a safer investment, it might be looking to provide you about 4 to 5% interest. Whereas if you go for a riskier investment, they can offer you 8, 10, 15, sometimes even higher than that. But basically, keep this in mind. The higher the risk, the higher the potential reward, and the lower the risk, the lower the potential reward. Now, that's all well and good, but what kind of assets can we actually invest into? Well, there are 5 main assets when it comes to investing. The first one is just cash. So this could refer to actually holding cash or putting it into a bank account. That would all be cash, and of course this asset class has very little risk, but of course there is also very little return. If you're just holding actual cash under your mattress or something, obviously you don't get any interest on that. And if you're holding it in your bank account, even if it's in a high interest savings account, it's usually not more than like 2 or 3% at most. Now, there are some benefits to keeping cash, and the main benefit actually is that it is liquid. Now, what a liquid asset is, it's basically an asset that is easy to turn into other assets. For example, if I have $1,000 in cash, I can just take that and go out there and buy anything, any asset, anything else I want. I can use that money right away. Whereas with all these other assets that we're going to take a look at, that's not always necessarily the case, but we'll get into that in a second. Now, the next asset class is bonds, and stuff like GICs, which are guaranteed investment certificates, or CDs, that would all also fall into this category. This asset class is basically an agreement where you lend someone your money, and in return, they pay you interest over time, and also at the end of a very specified period, they return your entire money as well. So what does that look like exactly? Let's go over an example. Let's say there's a company who is looking to raise money, and as such, they offer bonds. So in this example, they offer a 10-year bond at 5% interest. And what that means is that if you go and purchase a bond at whatever amount, let's say it's a 10-year, $10,000 bond, then that means that you pay $10,000 to the company. In return, you get a contract where every single year you get 5% on that $10,000 wired to you, and then at the end of the 10 years, you get your $10,000 back. Now, right away, you might notice that, okay, that means that your money is tied up for that allotted amount of time. And as such, it's not liquid the same way your cash was. But there are still things you can do. For example, if you really need the money after, let's say, 3 years into the contract, then you could take your bond and sell it to someone else who's willing to buy it. But of course, there could always be complications. For example, maybe there is no one who's willing to buy it. Or even if there is, the interest rates may have gone up since you bought that bond. So let's say every company is offering 6% for a very similar sounding bond. Then in that case, your bond is actually worth less than what you paid for it, because right now, anyone who wants to, let's say, invest $10,000, they could just go and get a new bond and get 6% instead of your 5% bond. So if you want to just go and sell off your bond in such a situation, you would get less than what you actually put in there because the value of the bond has gone down. But of course, the opposite can also be true. Let's say the interest rates have gone down and every bond with a similar level of risk is offering now only 4% interest. Well, then in that case, your bond is actually worth more than the amount that you initially paid for it, because there is no other bond that you can, let's say, put your $10,000 into to get the same level of 5% interest with the same level of risk. Now, of course, there are always different levels of risk, and even with an asset like this, which is on the less risky side, there are still more risky bonds that you can invest into. Now, when you invest into a bond, the value of the bond, as long as you don't sell it and you just keep it until the end, it doesn't change. No matter what happens at the end of the, let's say, 10 years, you get your entire money back unless the company goes bankrupt. That's the only situation under which you might end up in trouble and lose your money. And in fact, that's how different risk classes are assigned to bonds. The more the company that is offering the bond is at the risk of going bankrupt and basically losing your money, then the riskier the bond is deemed to be, and the more interest they have to give you in order to get anyone to invest into it. So that's how you can have different risk classes of bonds as well. But just generally speaking, bonds are more on the safer side compared to some of these other assets, because as long as the company doesn't go bankrupt, you are guaranteed to get that interest every year, and you're also guaranteed to get your entire money back at the end of the term. Next up, we have real estate, and this one is somewhere in the mid to high risk territory. Now, the best thing about real estate is that you can leverage things like mortgages in order to purchase an asset much beyond your current means. But of course, the most problematic thing with real estate is that it is not liquid at all. Remember how we talked about with cash, it's super liquid, you can turn it into any other asset at any point you want? Well, if you've bought a house, you can't just trade that for anything else at a moment's notice. If you want to sell your house, well, first you need to consider, is it a good market to sell in? Are there enough buyers? Is there enough interest? Then you got to get an agent. You got to make sure your house is on the market. You got to get an appraisal so you can see what it's worth. And then you just have to sit and wait for someone to come and make an offer. And even when that happens, you're still not done. They still have to come and inspect the house. There's the escrow process. So it takes a long time to get actual cash for your real estate. Also, most people have this misconception about real estate that it's a super safe and super reliable investment, and that's not necessarily the case. Yes, in a number of major cities, real estate prices have gone up through the roof over the past decade or two, but there have also been turbulent times before as well. Obviously, the 2008 housing market crash is the most notable example, but even that aside, real estate prices aren't always a steady climb either. Now, the thing with a lot of these other investments, where you can see the number on a screen almost every day, is that you see when it's going up, when it's going down, when it's changing on a daily basis. But since since with something like a real estate, you need to make an appraisal in order to actually find out how much the house is worth that day, people don't actually find out about all the times where the market goes slightly up and then slightly down and a little bit more up and a little bit more down. They just see that after, oh, let's say 5 years, it went up a little bit or it stayed steady, or whatever else is the case. But of course, the main value of real estate is one that you can leverage things like mortgages in order to invest into much more that you can afford, and also the fact that you can rent it out. You can rent out part of the house or you can rent out the entirety of the property. And of course, if you do the math and you find the right property, you might even find situations where the rental income covers most, if not all, of the mortgage cost. So there are definitely a lot of upsides to this asset class, but it's not as simple and clear-cut as most people think. Next up, we have the stock market, and this includes stuff like individual stocks, index funds, and ETFs. Now, this asset class is generally high risk, but we need to talk about what risk actually means. Because most of the time when people think of risk, they actually think of risk of ruin, which is a different thing altogether. Now, risk of ruin is the risk of whatever your investment is going to complete zero and losing everything. Whereas risk itself doesn't necessarily talk about risk of ruin, but more so about the volatility of the asset. But before we talk about how that relates to stocks, let's first talk about what stocks actually are. Now, stocks are basically very small portions of each company that is being sold to investors. So for example, when you buy one Apple stock, you are basically buying a very small portion of that company, and now you own a tiny bit of Apple corporations. And as such, if the company goes up in value, your stock also goes up in value. Also, each stock has a feature known as a dividend, which is basically the way each company shares a part of their income with the actual investors. Now, of course, depending on the company, they offer a different amount of dividends to their investors. And usually the companies that have the highest potential to grow actually offer the smallest amount of dividends because they don't need to offer that to entice investors. You know, investors would already be lining up to invest because there's so much value to be had with the company going up in value. Whereas with companies that don't have a lot of potential for growth, or at least are not expected to grow a lot in the coming years, those companies have to offer a lot more dividends in order to entice investors to buy a portion of their company, which means that they have to share a larger portion of their income with the investors, which would be you. But now let's get back to risk and what we were talking about earlier. Now, when you pick an individual stock, let's say you invested into Google or Microsoft or whatever, there is a chance that that company could go bankrupt. There have been a lot of great companies in the past that everyone thought was going to be around forever, whether you talk about stuff like Nokia or Blockbuster or so many other examples. These companies were doing very well for a very long time, but at some point they just ran out of steam. And of course, the same could happen with any single company as well. If you're investing into Google, it might look like Google is going to be fine, at least for the coming years, but you never know. At any point, it could go bankrupt because at the end of the day, it's just one company. So not only are you taking on a considerable amount of risk with that investment, you also have the risk of ruin right there as well. It might not be a ton, but it definitely is still there. Whereas if you invest into stuff like index funds, then it's a different story. But what is an index fund? An index fund is basically a fund that has taken a small portion of a bunch of different stocks and has put them all into one package. For example, the S&P 500 is probably the most famous index fund out there. And what that index fund is basically the top 500 companies in the United States. And they've basically gone there and taken a small portion of each of those stocks and have put it all into one fund that you can invest into. But investing into index funds directly is a bit more complicated than just buying stocks. But there is an option for you to buy exchange traded funds instead. Now, exchange traded funds, or ETFs for short, are basically the same as index funds, but just their version on the stock market. So when you go into a brokerage account and you buy stocks, you can also buy ETFs right there as well. And basically whatever index funds are out there, whether it's S&P 500, the NASDAQ index, or whatever other index you're interested in, there's usually an ETF equivalent for that as well. For example, for S&P 500, there is VOO. For the NASDAQ index, there's QQQ, and so on and so forth. Now, the difference with investing into index funds or ETFs is that you're not investing into any one single company. So even though there is still risk there, and we're going to get into what that actually means in a second, the risk of ruin is not there anymore. Well, I mean, sure, it is possible that the entire market could crash, but there will need to be a zombie apocalypse or something for that to happen. So if that happens, you probably have bigger problems anyways. So barring some zombie apocalypse or anything crazy like that, there's no way every single company would go bankrupt altogether. So when you invest into a broad index fund or an ETF equivalent of that, you're basically protecting yourself against the risk of ruin. And that's the power of diversifying. When you diversify into a bunch of different companies instead of just one particular company here or there, then you're basically getting rid of the risk of ruin and you are actually investing intelligently instead of just playing roulette and hoping for the best. But now let's talk about risk itself. We talked about how risk means volatility. So what does that mean? Well, if you look at how the market performs, and particularly if you look at the S&P 500, which is a very good indicator of how the market is performing as a whole, then you can see that there are some years where it goes up a lot and then some years where it's going down, and it's just a mix of the two. In fact, when the market is going up by a significant amount, that is called a bull market, and when it's going down by a significant amount, that is called a bear market. And these markets come and go on a regular basis. Once every couple of years, we have a crazy bull market where everyone thinks they're making a ton of money with their investments. And then once every couple of years, we have a bear market and it goes down a lot and everyone's investments are going down and everyone starts panicking. And that's basically what we're talking about in terms of volatility with risk. And the thing about the market is that you never know when it's going to go up, down, or sideways. It's just unpredictable. Well, at least it's unpredictable in the short term. Long term, we have a lot more reliable data. For example, for the 100+ years that the S&P 500 has been around, there has never been any 20-year period where the value of the S&P 500 didn't go up. That is significant because that's a direct evidence that all of these volatilities are only in the short term. Whereas in the long term, the market is much more reliable. Now, of course, part of that is because of inflation, part of that is because of the growing economy. And if you want to get into all the complicated economics, there's a ton of reasons for that. But just simply put, you can rely on the fact that in the long term, your investment should be doing well if you're investing into a broad index fund. But only in the long term. That's a period of at least 7 years or longer. Whereas in the short term, anything could happen. You don't know what's going to happen in the short term. It could go up, down, sideways. It's anybody's guess. And again, keep in mind when we're talking about the market going up, we're talking about the market as a whole if you're investing into broad index funds. If you're just investing into a single stock, again, even in the long term, we don't know what's going to happen with that because it's just one company. But when you're investing into a broad index fund, you're basically investing into the American economy. And even though the American economy can always have its hiccups and go up and down from time to time, over the long term, over the periods of 7 years or longer, it is much more reliable. Now, is this 100%? Of course not. Nothing is 100% at the end of the day. There's always some little bit of risk with everything. Again, zombie apocalypse could happen for all we know. But over the long term, the risk is nowhere near what people imagine. And that's the misunderstanding that a lot of people have. This is why for most people, particularly if you're investing for the long term, that is periods of 7 years or longer, or ideally it should be really 20 years or longer, that's how I look at it anyways, then in those instances, investing regularly into a broad index fund is probably the best way to go. Now, of course, this is not financial advice, it's just what I like to do with my investments, and I'm speaking as someone who has been investing for a long time, but this is exactly what I do. I regularly invest into a broad index fund, and I dollar cost average into the market. Now, dollar cost averaging basically means that you buy regularly in the same amount, regardless of where the price is at. And the idea of that is that over time, you're basically averaging out the price of that index fund, ETF, or stock or whatever. So that's what I do. I'm investing for the long term and I dollar cost average into a broad index fund without having to worry about it. And if the market goes down, and this is key, I don't panic because I know I'm investing for the long term, and if it goes down for a year or two and then it comes back up for a year or two and then it goes back down, it doesn't matter. The important thing is that at the end, after 20, 30, 40 years, I am getting the returns that I'm looking for. And of course, I'm going to show you exactly what the S&P 500 would have returned for you if you invested 20 years ago, 30 years ago, 40 years ago, so you can kind of get an idea of what you're looking at over the long term. Now, are those same numbers guaranteed to happen in the next 20, 30, or 40 years? Of course not. Past performance does not guarantee future results, but it does give you a good idea of what you can kinda sorta expect. And again, if you're investing for the long term and you have the time to wait it out, if you're not, let's say, retiring in a couple of years or something like that, then in that case, you can wait it out and it's totally fine and it's definitely worth it in order to get those higher return rates per year. Now, last but not least, we have an asset class where I've pretty much just put everything else in there. So this is commodities, Forex, crypto, all that stuff. All the super volatile, super risky stuff that honestly, you're better off just not touching it all. Now, some people like to just get a little bit of this just to diversify their portfolio, and I suppose that's fine if you just don't overindulge into them. Like investing a little bit into a Bitcoin or an Ethereum, it's not the end of the world, that's fine. Although keep in mind the risk is definitely there and it's much higher than anything with stocks or whatever. But to be fair, the potential for return is also there. So if you want to just indulge a little bit, that's totally fine. But just make sure it's not more than 10% of your entire investments. Because with things like Bitcoin or Ethereum, they could go to zero just like that. Or they could go to $1 million just like that. That's also possible, I suppose. But again, that's kind of where you're getting into roulette territory again. I don't think you want to put all your eggs in that one basket. But now that we've gone over all of them, what should you look into investing into? Well, you always want to keep some cash just for emergencies or if you need liquidity. Usually you need at least 3 to 6 months worth of your expenses in an emergency fund, in a savings account or something like that. And then if you need liquidity for stuff, for example, if you're looking to put a down payment on a home, then you need to save that in cash as well. But other than that, you don't want to keep too much cash on hand because remember, cash is losing its value every single year and it's not getting you any returns on your investment. Now, if you're in your 20s or 30s or maybe even early 40s, you should be looking to invest for the long term, and that's where mostly things like ETFs and index funds can be really handy. If you also want to invest into some more riskier stuff like some crypto, maybe some commodities like gold or whatever, or even some individual stocks which are again more risky, that's fine. Just make sure you don't overindulge in them. Make sure it's not more than 10% of your portfolio. But then once you start getting into your late 40s or 50s or 60s, now you're getting closer and closer to retirement, which means that you don't want to put it all into these volatile assets because soon you're going to be needing to take money out from your investments just, to spend in your retirement. Then in that case, and again, depending on how close you are to retirement, you want to balance out your portfolio with a lot more safer options like bonds, GICs, CDs, or maybe even some more cash in a savings account. And again, the closer you get to retirement, the more you want to be investing into safer assets because at that point, it's no longer about getting the most possible return on your money, but now it's mostly about preserving your wealth. Now that was a quick overview of all the key concepts that you need to know about before you start investing. Let me know if you have any questions about any of this stuff. I try to always answer every single question that comes in. But with that said, hope you guys enjoyed that and I will see you in the next video. Cheers.